Private credit inflows getting a boost, and my next guest is seeing even more positive signs ahead for the credit market. Joining me now is Bruce Richards, CEO of Marathon Asset Management here at Post 9. Bruce, good to see you.
Good to see you, Mike.
Really, the credit markets, measured however you want to measure them, through this entire year, which has been noisy with the tariff scare and everything, have really not buckled at all, right? Spreads remain tight. Demand for credit product remains good. Is that rational? Do you expect it to last?
Credit should be boring. That's the first thing. We shouldn't have the big credit events. The truth is, over the last few weeks, credit has come ratcheting in. The high-yield bond market is 300 spread now, which is towards the all-time tights. That's 50 basis points tighter or lower in yield than it was just a month ago. So it's actually performance-wise, price-wise, done exceptionally well.
Go ahead.
And so we like a boring credit market. Very few credit events, and that's healthy for the economy. It's healthy for the borrowers. It's healthy for us as investors. We love this type of market.
So does the economy as it sits right now and as you expect it to develop over the next few months support that continued strength? I guess that's the question, because there is a legitimate debate out there as to whether, we had negative first quarter GDP. It was technical reasons, but it seems as if growth has been moderating or decelerating. Is that okay for the credit market?
The first half of the year, 2.2% GDP is what I think it comes in at blended, first quarter, second quarter. The second half of the year, I think it probably slows to about 1.5%. They're both okay. And so a 2% GDP, and I also believe that inflation won't tick up to the extent that the Fed is worried about. Say it's 2% inflation. I believe that's where we're going to kind of settle into. And that's a beautiful thing. 2% inflation, 2% GDP growth, maybe it's a little lower than that, won't allow the Fed at all to keep rates this high over a long period of time.
So you think the Fed needs to get moving sooner than later, or it has to just wait and see to make sure that doesn't get into the inflation?
They won't get moving sooner or later because there's no Fed cut coming in July, and unlikely in September.
You think it's unlikely?
It's unlikely in September. But what I've been saying is this calendar year, 1 to 2 Fed cuts. I believe it's more the fourth quarter. And I believe it's once Powell and the other hawks at the Fed have the evidence that tariffs have not been inflationary, that tariffs have not caused the economy to do what it's going to do. So I think that the Fed is going to ease, but it's going to be the fourth quarter. I also think that Powell will probably ease 4 times by the time May of next year rolls around. And I think the rates are simply too high. Yeah,
so that gets you to some estimate, where the committee sort of feels like rates should settle out, for this cycle, like 3.5.
Well, I think the rate is 3% because you look at the ECB, look at what's happening in Europe. You have 1% growth, 1% inflation. And when you have inflation and growth at 1%, where's their natural rate? It's 2%. And that's what the ECB has done, brought rates down from 4.5 to 2. What has our central bank done? They brought rates down from 5.5 to 4.5 with 2% growth and what's probably going to be 2% inflation. 4.5 is too high. What's parity? Parity is 3%, I believe. I believe that's where we'll eventually get to. I believe the next Fed governor come May of next, or chair come May of next year, will be a dove that understands rates have to come down. It'll be a very healthy thing for the economy and very healthy for funding our federal deficits.